All right, my name is Darren Joseph from ACJ.tax, the team that seeks to demystify the sometimes confusing world of cross-border taxation. And today we have the honor and the privilege of having a conversation with Roger. Roger, can you please introduce yourself?
Hey, Darren, how are you? And hello, everyone. My name is Roger Chi. I'm the CEO of the Singapore office for 1291 Group. We are based in Zurich with 13 offices around the world. Zurich, Geneva, Liechtenstein, London, Panama, Bogota, Sao Paulo, Mexico City, Dubai, Hong Kong, and most importantly, here in Singapore.
I guess conventional thinking, and you'll correct us if I'm wrong, is that it's a relatively expensive structure to set up and maintain. How would you respond to that? Is it?
Yeah, so I actually think there's a lot of misperceptions in the market. And actually, I think that's not true. So the running cost of PPLIs is generally maybe a setup cost of 1% or less, and an ongoing of 1% or less, right? And oftentimes when we do these structures, we do a cost benefit analysis on these different things. And let's say if you're a U.S. tax resident, for example, right? If a U.S. tax resident, you may have a tax drag on a short-term basis of 37%. If you're a California tax resident, there's another 13% on top of it, to close to 50%, plus maybe 2% Medicare, so well over 50%, unfortunately. Or even for a capital gains basis, it's 22% plus the 13, right? But even if you're living offshore, it's 37%, 20 or 22%, depending on how long you own those assets. In a PPLI structure, one of the key things that it allows you to tax defer any of the gains you make. So basically, if you have any capital gains, you don't have to pay those taxes right away. It just accrues and capitalizes. So basically, you don't have to pay those taxes. So, paying 22% tax versus paying 1% on overall assets, a lot of times the math makes sense, right? You're actually net ahead by doing these different things. There's also some interesting things we can do around reclaiming withholding taxes. So, let's say, I'm based in Singapore, for example. I have a lot of clients in Singapore. They may invest in a lot of U.S. stocks. Everybody invests in U.S. stocks. Everybody buys Apple stock or Amazon or Exxon or Walmart. A lot of these stocks may pay dividends. Unfortunately, there's a withholding tax, which you may or may not be aware of. And the withholding tax coming out of the U.S. is traditionally 30%. That's the state withholding tax. Singapore, if you're a Singapore tax resident, you pay 30% withholding tax. But there's a neat quirk here is that we have insurance companies in 15 jurisdictions. And all of a sudden, I can pick a jurisdiction that has a very good double tax treaty. Let's say it's in Ireland or Luxembourg. So it has a very good double tax treaty, or in Austria, very good double tax treaty, because these countries have been friends with the U.S. for a long time. And all of a sudden, the withholding tax is not 30%, it's 15%. And that's just free money, right? So I have one client, for example, last year in Singapore, we saved him $60,000 in just reclaiming withholding taxes from the US or from the UK or from Switzerland, lots of different things. So there's lots of unique sort of things that we can do with these different structures that actually makes it very cost effective. And oftentimes, the marginal cost is you're many times ahead by using these structures and not using them.
So if you're a 6, 7, or 8-figure investor, entrepreneur, or business owner who needs a tailor-made solution from a qualified team of professionals, we can help you achieve the international lifestyle, the freedom, and even the tax savings you're looking for. Visit us at htj.tax and live that international life.